Good morning, everyone, and welcome to another webinar. Today, we're talking about COVID-19 and tax planning. And this topic today is going to take us beyond the government support that's happening right now and looking at how all this activity that we've got going on in relation to the various stimulus packages, how's that going to impact the tax position at year end for all our businesses. In fact, we've been looking at, we feel the next 2 months, potentially the most important tax planning period that we've ever actually seen. Due to the nuances and subtleties of the various stimulus packages, they're not all the same. And at the moment, we're worried about cash flow and getting the packages, but what about the tax planning leading up? So we've been investigating this, and Tim will run through that shortly. And we've found some very unexpected situations that, especially around JobKeeper. So look out for that as we get into it. Before we do that, though, I just want to bring your attention to our disclaimer. And the reason we put that up there is that we are really talking about specific tax issues. And please don't think that this short, sharp session is the answer to everything. Every business owner should get their individual advice. So let's get into it. And first up, we're going to have a look at JobKeeper payments. And a lot of business owners have been applying for the JobKeeper stimulus package, which, because they've basically experienced a drop in revenue. And therefore, the default expectation is that if I've dropped in revenue and I'm applying for JobKeeper, then I'm not going to have a tax problem this year. Well, we found that the opposite may be true in a couple of situations. So I'm going to hand over to Tim now to run through those scenarios. Tim, all yours.
Yeah, thanks, Michael. I guess one of the things I'll say for a start here too is whether you're getting JobKeeper payments or not, the tax planning is critically important this year. We'll go through a few of those later on. But specific to JobKeeper, a couple of issues there is we need to realise that it's taxable income when it comes on receipt. So when we receive the JobKeeper payments, they will be treated as income, and therefore the top-up payments that are made to employees, as well as your normal wages, are also deductible. So this is where our tax issue is actually starting from. So we have this additional revenue source and we have this additional expenditure. But the real point that leads us to this issue is that we're actually looking at, okay, eligibility is all about turnover and not profitability. So it is possible, and we'll show some examples, or I'll show an example at least, where turnover will reduce, but with JobKeeper supplements, what we'll see is an increase in profitability because of margins and the like. And also what's happening is business owners are being quite savvy, and they're working their way through different ways of reducing overhead costs and making quick decisions, things like reducing rents, reducing some IT costs, even things like electricity and gas and the like, if they're using less provisions from their office. And we'll show how that actually impacts as well. So the important thing here is we can actually end up with a business who's receiving JobKeeper payments, and they'll potentially increase their profit as a result of that, which will create some tax issues. So if we just run through a quick example on that, and we've got here a turnover business with, let's call it 1.2 million and a 20% gross profit margin. The revenue of that business, it drops to say $800,000. So we've got a 1/3 drop off. Therefore, that's more than 30%, and JobKeeper comes into play. But what they also do is they make some overhead savings of, let's call it $40,000 between the months of, say, March through to June this year, so $10,000 a month. Things like reducing the rent, as we mentioned before, overhead costs, even some of the staff training provisions they may have had that go with that. So they save some money there. So top line, they dropped $400,000 in revenue, and on overheads, they've been able to save $40,000. We just use an example here of a business has 10 employees, and this is actually pulled from a real life example from one of our clients. So 3 full-time, 2 part-time, 5 casual employees. And with JobKeeper, for those who are enrolled, you'll know that there's top-up payments required to get people up to earning $1,500 per fortnight, regardless of what they've earned in the past. So for those people, let's say this example here, there's a $4,500 top-up payment. So this has been something that's triggered for us a little bit of question marks around, if we're going to get $4,500 extra going out, aren't we going further backwards? But the reality is that the JobKeeper fortnightly income, in this case, would be $15,000 per fortnight. That's the 10 employees multiplied by $1,500 per fortnight. Now, what we've actually also done here is look just the period up to 30 June, because the reality is we're talking for tax planning, 30 June being a lock load date. And what we're going to see is the negatives on this situation is they are going to have to pay extra $4,500 out per fortnight for 6 fortnights, and they have had a reduction in revenue of $400,000, but they would have had also the reduction only being at 20% of that in a real reduction to their overall profitability, because that's the gross profit margin. So whenever we're selling something which has an input cost, there's a gross profit margin, and that's the sort of thing where our clients really should know what their margin is. But the positives are there's going to be a $15,000 payment coming in each fortnight for the 6 fortnights, and there's this $40,000 savings through clever business behaviour. Where that brings us to is actual fact a profit increase this year of $23,000. And if we do nothing, we've now got extra tax payable. So it becomes really relevant to think, okay, we've received these payments, yet using a company tax rate at say 30%, give or take, all of a sudden they're going to actually have an extra tax bill of around about $7,000 to $8,000 that you didn't see coming unless you did some planning. So that's one of the issues we found straight away, and why tax planning this year is more important than ever. The other issue that we've found so far is around the business cash flow boost. So a number of business owners actually will have already seen the financial benefit of this stimulus measure, and this doesn't matter whether you're registered for JobKeeper or not. It's triggered by the March BAS lodgement, and April, May and June BAS lodgements also will trigger further business cash flow boost potentially, where you're actually employing people within your business. And it's all based around the PAYG withholding. So we've seen people receiving anything refunds, or at least credits, I should say, anything from $10,000 through to one we saw we had recently, which is a $47,000 credit already. Now that will go up to $50,000, and then there'll be a doubling. So over the next 12 months, it'll be $100,000. But between now and 30 June, it'll be for most people somewhere between $10,000 and $50,000. And this payment is tax-free, absolutely tax-free, no questions asked. It's treated as exempt income. That's not a problem. So if you're an individual or a partnership operation, it's tax-free, it's your money. But where we're finding we've actually played out the long game a little bit further is, so well, what about companies and what about trusts? And we're going to have to do some strategic thinking around this, because if the business is getting the benefit and then the owners want to take some of that money out of the business to supplement perhaps their own incomes or the like, well, if there's a company, we're going to have to think through, is the cash is drawn, is it a wage? Is it a dividend? Is it a loan? If it's a loan, well then how are we going to actually repay that to the company? How does all this work? Because it was tax-free on the way in, so it will affect those who have companies, franking credits. There'll be an issue there to talk our way through. And then the trust. Trusts are a different beast again. So if you've got a trust involved, the first thing we know now is that your taxable income won't equal your trust profit. Now, we're getting a little bit deeper here, but what we're talking about there is your trust deed governs how we treat profits. And where taxable income doesn't equal the trust profit, we need to be really careful as to how we allocate the distribution of profits, and be aware of, are we using a proportionate approach or are we using a direct approach? And again, that's sort of a technical discussion, but really important that all I want to highlight here is the issues that are there. So what that means is this resolution, those who have had trusts over the past years, they'll know that over the next month and a half, we'll be doing trust resolutions and working through how we're going to distribute the profit through the family group. Well, the resolution is more critical than ever this year. There's a case in 2012 called the Bamford case, which is right behind this. And that talks about what's going on, how we actually distribute in the case of where taxable income doesn't equal trust profits. So the distribution resolution is critical. And also really critical it gets done before 30 June. And then there's this issue of losses. So what we might find is that a trust has a tax loss, but a gain actually in the trust itself because of this business cash flow boost. We're then going to work through how exempt income is treated in the trust. So we just start to uncover the onion and realise that yes, there's money coming into the business or tax credits either way, but these are real technical accounting matters and tax matters that need to be dealt with sooner rather than later, because we do have this 30 June date looming. Well, 2 months from today as we record, it's been the 30th of April. So what that means for us is that tax planning has never been more critical than in 2020. So whether you're getting a JobKeeper payment or you're not, if you're getting a business cash flow boost, which most people who employ will be, this is really critical stuff. And maybe what I might do now, Michael, is I'll throw it to you. That's the technical, boring stuff that no one wants to have to deal with from a business point of view. But let's talk about what action plan should be happening for clients as they work towards the 2020 tax planning.
Absolutely. Thanks, Tim. Yeah, and thanks for those examples. And the example you gave there of, someone with 10 employees, but even if you don't have it, only have one employee, or there's just, eligible business participants, this JobKeeper, it's a reimbursement. So in other words, we're getting paid a month down the track. So there's a mismatch of revenue and expenses anyway. So it's going to cause some issues, whether you have 10 employees or there's just yourselves. So really important to understand that. So thank you. So yes, tax planning actions. Here's a quick guide, if you like, to the next steps of tax planning. And we do want to stress that this is an action that every business owner who wants to not only just minimise their tax, but maximise their cash flow should go through. And we've had many examples over the years where clients have told us that tax planning is the most important meeting they ever have with us. So as a matter of interest, just on that, anyone who wants to do tax planning, we do have a guarantee that the tax savings that you get or are available to you aren't double what our costs are, and there's no charge. So the reality is, you can't really come out of that in a losing situation. So I really highly recommend tax planning between now and June. So what you need to do, first of all, step one, get your accounting data up to date by the end of April. So if you're in Xero or Cashflow Manager or Mile, QuickBooks, doesn't matter, get everything into the software, get it reconciled and up to date. Step two is what we do is we create a May-June forecast, and we come up with a base tax position. In other words, if we did no tax planning, this is your tax position right now. Step three, this is where the fun begins. We can stress test up to maybe 10 different strategies per client that can save tax. And we do consider the tax flow implications and the tax implications and cash flow as well. And we work out an agreed plan, if you like, for the upcoming months as part of step three. And step four, which is where most of the action is that we implement. We can make decisions, but we've got to take action as well. So we need to implement. That's basically where our 4-step process. So in doing all this, we're really, really aware of living into our promise of providing easy to understand advice that works, because there's a lot of things that go on behind the scenes. There's all these permutations, combinations, systems, algorithms, but what is very clear, and you as our clients have told us many times before, Michael, Tim, we really don't care about all these permutations and combinations and things that you do behind the scenes. We just want to know how much tax can I save and how much cash will it take for that to happen. So great, we're actually very conscious of that. But I actually will throw back to you, Tim. We were having a chat the other day and you said this tax planning phase for the next 2 months is so critical. It's really like renovating a house. Tim, do you want to enlighten our listeners as to how you think tax planning is like renovating a house?
Yeah, maybe it's just something in my mind because I see it happening a little bit down the street. We've got a house renovation happening down the street here, and it all started from a little bit of movement in the house. And I was chatting to the guy down there, and they had to do some re-stumping work. Then they did some re-stumping work. Oh, the windows have moved. The doors have moved. Oh, we've got some plaster cracks. Oh, rightio, so we better get that sorted. We've got some painting issues now. So what we're seeing as tax planning, and particularly through all the stimulus packages, is the front end is very, very, I won't say it's straightforward or clear, but it's clear in the sense of there's some money coming in, here you go, let's look after your business. The stages 2, 3, 4, and 5 of that, which is when the restumping is all well and good, but let's do the follow-up steps, is what we're talking about here. Because it's no good restumping your house and then not actually redoing everything else that's required, because you put all this effort in to make sure your business is safe and sound, and then you don't bother, let's say, fix up the windows, and you still have drafts in the house. Similar for tax planning in this concept is, if you don't use it to your advantage, well, then potentially some of the benefits of the JobKeeper or business stimulus packages, which is the equivalent of the restumping, is actually not flowing through to the whole house. So it's a bit of a loose analogy, but I hope it makes a bit of sense as to how one little change means 3 or 4 changes down the track.
Absolutely. Yeah, thank you. We've said it before, for every action, there is a reaction, or at least one reaction. So we need to work through those. And that's what we do. So all that aside, is one thing for sure, that in spite of all these changes that we're going through, the one thing that doesn't change is the calendar. June 30 is June 30, and that's D-Day for most actions. So we've just highlighted here the importance of some of them. Your super contributions, they must be in the super fund bank account by June 30. Not just to come out of your bank account, they must be physically in the super fund bank account. Leave yourself some time. Trust resolutions, Tim, you've touched on that before. They must be completed and signed by June 30. And some of you may be, if you've got the cash flow, taking advantage of asset purchases and the instant asset write-off up to now 150,000. But those assets must be installed and ready for use by June 30. Really important date, because we are, as Tim said before, we're at 30th of April right now. We're only 2 months away, and time will get away if we don't get into this very soon. So I'm going to leave it there today. And as mentioned earlier, it could get missed, this tax planning, but really, it's really important that we use 2020, because there's been so many movements, moving parts. We need to do some tax planning. We've got our contact details there, and in May, you'll see us putting out some more information around this. But if you want to jump ahead of the crowd and work out a specific plan for you, please just give us a call, and we'll do that. Thanks again for joining us today. We're really enjoying these regular Thursday morning sessions. So please tell your friends and anyone else who's in business, because like you, we're trying to pivot our business and do things differently. And we would love the opportunity to work with more business owners like yourself. And if anyone's out there that you know of that's looking for an accounting team that can deliver when it really counts, we'd love to work with them. So that's all for today. Have a great day, and thanks again for joining us.